Welcome back to Wealth Quest. We value your feedback. Please send us any emails, questions or comments to wealthquest@abn360.com. And of course, you can find us on www.abndigital.com. You can find our past shows there and Cobie's blog. Let's continue with the topic of the week and reviewing the Q1 fund performances that we saw coming through. So we're starting off with domestic allocation, David. But if you could just define domestic allocation, I mean, what type of funds fit into this category?
Okay, it's an amalgamation of several different fund categories as defined by ASISA. So the multi-asset funds can either be domestic, so South African based, or foreign. So we're looking at this case South African ones. And then the categories get subdivided by how much weight these funds have to equity versus fixed income. And so you'll have, maybe a South African high equity allocation category. You'd have one that's sort of a medium equity and then a low equity, and then there's one that's flexible. So what I've done is combined all those categories just to get a sense for which funds among that general type have done well.
So I mean,
poorly.
In essence, what you're trying to do here is if a manager likes to have, firstly, the allocation decision. So hence, do I want to own equities, bonds, property or cash? That's the first decision. And then once the decision has been made, the second decision is what asset class or what assets would I like to own in each one of the asset classes. That's the secondary decision. Now, many guys that are in the equity space will say, listen, I'd like to own equities. So I'm not, this is a single mandate, equity only type mandate. I don't want to have the flexibility. In this category, we've literally got a catchphrase as far as all the managers are concerned, that want to firstly make an asset allocation decision and then secondly want to make an asset decision. Let's maybe quickly show you what some of these returns look like for what we call now domestic allocation. Right at the top there is the ClucasGray Future Titans Fund, a business for which I am a strategist, run by Brendan Hubbard. Consider him Met Flexible as the second fund over there, run by a gentleman by the name of Dave Colombo, up by about 10.4%. And then you can see some of the other returns that you've had from those categories. Just moving on to worst, and there you can see Third Circle Met Targeted. That was the worst performing fund. But I mean, again, this is what we call a fund of funds. If you go and have a look at the fund fact sheet, you'll see there's the well-known names are kind of inside that fund as they buy units of other funds in order to try and build a total targeted return as far as these returns are concerned. Again, not necessarily comparable, but maybe, and again, this is why objectives are so important, and again, investor objectives are important, and being able to marry the two.
David, have you got any idea how these funds at the top got their sort of performance? I mean, we're looking at 11% in the 3 months, and remember that domestically, only industrials really had that kind of performance. So did they have a high industrial bias? Did they have some kind of offshore allocation that, from the Rand's perspective, boosted these returns? It was quite difficult to get a return of 10 or 11%. Maybe we should ask Cobie, because he's the strategist of the fund.
I'm just going to say.
To see where these returns came from. But it's clearly not just equity in this case.
I can't say I'm intimately familiar with the 4 of those funds on that list. I would guess, yeah, you're going to have some foreign equity exposure. A lot of the funds would be allowed to have up to 25% outside of South Africa and still be Reg 28 compliant. And my guess is that that's what's happening. But Cobie, what happened over at ClucasGray?
Well, I mean, I suppose the first thing that you need to take into consideration for Future Titans is that it's a fund that will firstly buy smaller large caps, and with an emphasis though on what we call mid caps and small caps, both locally and globally. And one of the things here that has worked quite nicely in favor of the fund is the fact that it's owned about 20% in cash. As it's continuously trying to find new investment opportunities, the sector itself has done phenomenally well. Mid caps and small caps have done phenomenally well. And to try and now find obviously new buying opportunities, you're kind of sitting in cash and you're waiting to kind of apply those buying opportunities. Very well diversified, by the way. You're holding in this fund specifically, Brendan Hubbard will hold probably between 30 and 40 counters, which is a lot of counters to hold, and it's something
what about going through understanding all those moving companies and everything? Hard to get your head around all the dynamics playing out in each one of those.
Well, you see, I think the danger that you face in a fund such as the Future Titans Fund is that if you have very concentrated type of bets, if one of those move against you in the mid-small cap space, you don't have the liquidity, you don't have the ability to quickly move out of the stock. So you want to introduce a whole bunch of ideas into the fund that's well researched. And I suppose one of the big things of the fund is that they kick the tires. You know, they go and they visit the actual companies. Introduce them, and if they run, they'll obviously naturally kind of go up the progression scale as far as your holdings are concerned. And then secondly, you can obviously add to those as well.
So it really does highlight the importance of, if you're investing in that smaller cap space, the importance of having a scale there and having, you know, a lot of stocks in the portfolio. We went through domestic allocation, the worst performers there, certainly not as good as what we saw from the best performers. Let's move on to the fixed income space. You've got Absa Fundisa coming through with 2.9%, and certainly pales relative to the equity space.
Yeah, I mean, let's have a look at those. There you can see them on your screen. Absa Fundisa. Remember, that's for nominated child education. And then remember, there's a certain bonus amount that gets kind of added on to this after every 12 months. So you can see there 2.9%, Milton Optimal up at 1.7. Let's quickly move on to what we call worst domestic fixed income. And there you can see some of those. The Advantage Active Bond Fund down minus 0.2. Yeah, and there you can see some returns. I mean, it's surprising to me. You know, we've seen bonds, we've seen the heyday of bonds kind of coming to an end. It's tilting to an end. But if you look at the sell down we've seen money moving back again into fixed income and less money kind of flowing towards equities. But how much lower can you go? You know, as far as yields are concerned.
Our bond market's actually done quite well in the first quarter. I mean, the yields have definitely come down and boosted the returns, and the question is why, because there shouldn't have been that kind of run, but it might be foreigners again that are still wanting that higher yield in South Africa.
Yeah, David, we're seeing some of these funds on the domestic fixed income space, not with a rating here in South Africa so far, and some of them don't have that longer track record. But what can you tell us about the best performers we saw for Q1?
Well, I mean, there's a couple things that stand out as just the range of returns between the best and the worst fixed income funds. I think is interesting. You don't see nearly the same type of swing, even though the worst performers are slightly negative. It's you know, that's not a bad start for fixed income. You know, these returns are still better than probably what you're seeing in most of the developed world, where you know yields and returns on fixed income are still pretty meager. So you know, that's not such a bad return for 1 quarter of the year in what's you know an asset class with a lot less risk.
So what are your thoughts right now, Roland, on the direction of bonds, given the fact that, as you say, even though there are a lot of fears around what foreigners are thinking about, for example, South Africa's bond market, we're still seeing net inflows into the bond market?
Yeah, a lot of people were quite bearish about the South African bonds, especially domestic investors, because it's run so hard. And also we saw sort of inflation coming through, the rand weakening. So there was a lot of concern about the bond market. But I think we might in the next few months see, you know, not as bad a returns as people expected, purely because global growth is slowing. Now you're seeing the gold price falling because inflation fears are coming back. So if that swamps over into South Africa and we start seeing a lower petrol price, we might see interest rates actually staying where they are or even going a bit lower. The central bank's certainly not going to lower interest rates, but what I'm saying is that the fear of inflation might not be as big as we thought it was.
Depending on, of course, that oil price. So David, and the rand. David, you were fresh off the boat when we first spoke to you from Canada, and there's been a few quarters that you've been able to get your head around the world of fund management here in South Africa and meet some of the fund managers. So tell us about some of the funds that you're looking at right now, some of the funds that you've covered in Q1.
I have covered officially 3 South African funds. They're all Ned Group funds run by the team over at ABAX. So those funds include the Ned Group Investments Rainmaker, their Opportunity Fund, and their Entrepreneur. You know, ABAX seems like a pretty quality shop with a well-defined investment process. The managers within the team, they've got sort of a broad framework that they share, but you know, they're allowed to express their own views. You know, I think pretty highly of them. The 2 of the funds out of the 3, I rated a recommendation of bronze. Just to briefly recap, our rating scale goes from gold, silver to bronze. neutral, and negative. And those metal standings are all funds that we would recommend. The better the, going up to silver and gold just would mean that I have more confidence in that recommendation. But it's still, there's still funds that I'd recommend. The one out of the three that I rated a neutral was the Opportunity Fund, which is a balanced fund. And ABAX isn't really known for their expertise in managing fixed income assets. I think they're in the process of trying to build their capabilities, but it's still relatively early going, and they don't have a whole lot of a track record with which to sort of base an analysis on. So it's a bit of a wait and see for half that fund at this point.